Hi everyone, welcome to the third quarter of 2021's edition of the UK Rental Market Report. Now this is where Zoopla send a report through, we dissect it, we run it alongside and we run it parallel with what we're seeing on the ground in cities like Manchester, Liverpool, Leeds, and we go through it bit by bit and see what it means for you as a landlord and as an investor. So look, without further ado, let's head in. So the most important thing is this headline figure in terms of rental percentages and the increase and the annual change in rents in the UK. Now we take these in a separate way. First of all we do it without London, and then we do it with London. Now London makes a big difference on the figures. When London's going strong, it's fantastic. It's the best city for investing, but that probably stopped around 2015-16 when the steam ran out of the London market. The stamp duty changed at that time, where overseas buyers and people with second homes had to pay a little bit extra on their stamp duty. So suddenly London become not really a viable place to invest. And of course that's then seen the rental market dwindle, especially during COVID. So that has a real drag on the market as a whole. But outside of London, we're looking at an annual change of 6% that you can see here. In terms of London, you're looking at sort of 1.6%. So as a whole, the annual for the UK, the annual rent change is 4.6%. But because we don't really focus too much on central London, we're looking at this figure here. So this is the 6%, so plus 6%. Now this is key as well, the affordability percentage of salary to cover the rent. So this is of a single earner here in the UK. So it's 37% of your salary. Now that's pretty high. What that means is it shows you how little room there is for manoeuvre in regards to actually saving money to buy. So that's why we think that the UK is spiralling into this nation of renters. Now, there are plenty of other countries in Europe where this is the norm. Spain, Germany, they are a lot of renters, and some of them rent until they're 35, 40, until they get onto the ladder. In some cases, I've got friends and family where they have mortgages started by their parents and taken over by the children. So I feel that this is the way that the UK is becoming, because the affordability percentage of the salary to cover the rent for a single earner is 37%. Now, by the time you've done your other things, whether it's commuting, electric, water, gas, and we know all those cost of living is going up, it leaves very little room to save for that deposit for your actual property. In terms of letting, now, as a whole of the UK average is 15 days. We're actually seeing it a lot quicker than that. We're putting stuff on the market within and 1 or 2 days it's gone. So we're seeing a lot quicker than that on average. But of course, this is taking into account secondary cities, towns, and of course London as a whole as well. And the monthly average rent is £968. So look, let's head down to a bit more of a summary here. So we've got strong rental demand in quarter three. It pushes the rental growth to its highest level in 13 years. London has swung back into positive territory, as you can see here. But I think that the key and what I'm demonstrating to people is that the rental demand is going to remain higher than supply. So the availability of properties to let is 43% below the 5-year average. So this continues to push in favour of landlords, investors who are looking at buy-to-let to be their investment vehicle for whatever it may be, for their pension, kids' university funds. Now, what did we see during COVID? Well, we saw a lot of papers and so-called experts reporting that there was going to be a huge drop-off in terms of the prices. That didn't happen. We were out there, we said really early on, it's not going to happen, the fundamentals aren't going to change. What also happened, the papers reported that everyone was moving out of the cities. There's this huge exodus. Again, that wasn't the case. What actually did happen is, if people were renting in city centres, they may have temporarily moved back home or back in with their friends outside because they couldn't get out of their apartment. So a lot of people did give up their apartment at that time. But we knew that the reality is that COVID would come to an end, the lockdowns would come to an end, and people would head back to the city centres. And you can see this first paragraph here. The average UK rents are up 4.6% as a whole to the end of September, and demand rebounded in city centres and strengthened around the country. So really what we're seeing now is city centres is really where the place is to be buying. I know a lot of people have thought that the papers and the experts were saying, well, it's outside of that, but it genuinely isn't. You will simply find better results within city centres with a combination of growth and income. And as I say, this just backs up what we're saying. We've got stock levels 43% below the 5-year average, which really puts pressure on rents. And you can see here, this is quite an interesting graph, rents rising across the UK. London here has had a bit of a roller coaster ride, but anything excluding London, big increase, and it's pretty steady. As I say, we had a little bit of a dip, but we've seen it right back up to the highest it's ever been. So we know that buy-to-let is still a really strong market. Rental growth is close to or at 10-year highs in most regions across the UK. Again, except London or Scotland. And actually, let's head down to the bottom of the report, and we can see those graphs. We'll come back in a minute to the top, but we can see those cities where rental is key. You've got Bristol, Nottingham, Glasgow, Cardiff and Sheffield. Now, what we have to look at is the combination of both growth and income. So if we take the top two growth cities, which were Liverpool and Manchester, and combine it with the rental income, well, Liverpool was 10% growth, or just over, and 6% rental income. So you're looking at 16% return on your money, and in Manchester as well. So again, the rents have grown by 4.7%, but you are still looking at give or take 6% income in that particular area. So with Manchester being growing at around about 8%, you've got 14% year on year coming back in on your investment in Manchester. And that's the crux of it. Where else can people put their money and say, do you know what, I can make 14% with very little chance of that property going to zero? We all know what the stock market can do in terms of how it can grow, but we all know what it can do in terms of when it plummets. Savings rates are at an all-time low. With inflation kicking in where it is, we need other places to put our money. So let's head back up and head to a couple more graphs, which I thought was pretty interesting. So we were here where you can see rents rising across the UK. But as we come down, to where is the most affordable and what's increasing at the most rapid rate, we can see actually, again, the most affordable is North East, North West, Yorkshire and Humber. These are the most affordable that are increasing at the highest rate as well. Of course, we've got the least affordable in London, and that's also increasing at the lowest rate. So this is, again, as an investor, this is where you want to be looking. You want to be looking at the North East, the North West. I personally feel the North West has a lot more stability than the North East, but again, the North East will still make a good investment. But the Northwest for me is where you want to be looking in terms of your leads, again, Yorkshire and Humber, but in the Northwest you've got your Liverpools and your Manchesters. And again, we're seeing here, even if we look in London, you've got activity in the London rental market rose markedly during the third quarter. That's as people get back to city centre living, people are coming back into the offices. We're seeing it. It sounds a ridiculous concept, but the reality is the coffee shops are a great place to judge how people are doing, because people go for coffees, and actually it's an expense people don't really need to pay. But the reality is when you see a really busy coffee shop, what we're seeing in Canary Wharf at the moment is that every single one that they're queuing outside, doesn't matter what time of day you're there, we can see that things are good and people are coming back to the city, people feel confident, and that's a big key. However, the downside of that is we're also seeing inflation as well. Now, again, you can see in this paragraph here, in the UK's other major cities, the swing back to the city centres is clear. This is really key, guys, because we've said it all along, stick with the city centres. You don't buy investments on a whim, on fashions. What you buy on fundamentals. And if the fundamentals remain, that the reality is that the city centre living is still the place, and the city centres is still the growth, where the growth is had, you stick with that. Doesn't matter the minor blips. But people, unfortunately, they've read papers, they've read the so-called experts, and they've bought outside city centres, and now people are coming back into the city centre. You can see here rental demand in the central zones of each of the cities in the chart below, at least double that in the first quarter of the year, again, except Edinburgh. So again, here, these are the rental growth rebounds in the central cities. This is a really key graph here. And again, you can see London, Birmingham, Edinburgh, Manchester, Leeds. But you can see London obviously had its the biggest jump. London is a place where mainly people just live to work, and that is obviously always going to rebound. But you can see here Manchester's rebounded, Edinburgh, Birmingham, Leeds as well, and Liverpool will be exactly the same. So everyone's heading back towards those city centres. And another key is the demand and supply. So we know that demand is extremely high for not only for buyers but also for renters, and supply is restricted. We had a big term where the construction industry was shut down. We're now seeing huge increases in prices of whatever it may be, steel, timber, plaster. And what that means is that many developers are simply saying, well, it's not financially viable to build. So we'll wait for those costs to come down. So the builds are slowing down. And that's going to really restrict supply as well. So for us here, it is just simply saying that when supply is restricted, and even if demand remains the same, that's going to have a big push on the price of things. So with demand increasing, we know that there's going to be a big imbalance in terms of that price. So prices are going to continue to increase in terms of a growth side, but also in terms of the rental side as well. And you can see here, in terms of the homes to let, demand is comfortably outstripping the supply. You've got 43% demand, and in terms of stocks of homes to let, we're down 43% here. In terms of the change of demand, now this is key as well. The distribution of rental demand in 2021 has changed the price scale. If we look at back in 2019, we can pretty much see here the peak price or the average price that people would pay is sort of this £400 to £500 gap here, and then it sort of petered off as it started to get a bit more pricey. And again, that changed in 2020. People started to warrant paying a little bit more money. Now, of course, COVID then changed that. People would have moved out, but now people are coming back. People are actually happy to pay a little bit more, because what they are looking at is potentially a little bit of outdoor space, because people do have in the back of their minds that there may be another lockdown. Again, I don't think there will, but in the back of their minds, they remember the first one. So whereas before they may have rented a one-bed flat in the middle of a city centre with no outdoor space, and by an outdoor space, I'm not talking about a balcony, but maybe a terrace or a park nearby. Now they're thinking, well, actually, let's get a location where I can go for a walk with a bit of greenery area, or there is an outdoor terrace where I can go and sit on the roof, or they will have some independent terrace or a communal terrace, which is for the building only. So they're willing to pay a little bit more money for that. So that's key. When you're buying at the moment, have a look at places that are near a location. In Liverpool, is it close to the river where people can walk along the river? Does it have an outdoor terrace? Does it have a balcony? All of those things add up, because people are willing to pay a little bit more, as you can see here. And again, in terms of the outlook, you've got, despite the pandemic, employment market remains relatively robust. I know that from even advertising for our own company. We really put a lot of ads out there, and the reality is people have a lot of choices at the moment. There's a great job market out there. And it's really an employees market. There's a great job market, which is people can demand what kind of jobs they want. So the signals are great for the rental property market moving into 2022. We do think the demand may ease in the coming months, because Q3 tends to be the busiest time of year. As we head into the seasonal rental market, we think it's going to quieten down. But then, of course, we expect it to pick up next spring and really have another kick on again. So overall, guys, if the rental market's strong, the buy-to-let market's strong. If the buy-to-let market's strong, again, what then that happens is that sucks supply out of what people are doing in terms of their actual living quarters. And again, what you then tend to find is that then leads on to higher growth. So a combination of high growth and high income means that buy-to-let is still a great market. And in terms of the areas that we keep saying about and what we've done over the last decade, again, it's just the same areas. The northeast, the northwest, your Manchesters, your Liverpools, they're the places to go. Take care and have a good rest of the week.